on the Bostonred Network. This is Numbers Man, and the episode this week in economics on the 14th of July 2018. Our partnership with Cranston Analytics. We bring this production to you, of course, without cost as normal. We can be found on the iHeart mobile app, the Stitcher app, the Tumbling app, Facebook, Twitter, and various other outlets. We're coming even to Spotify, if you can believe that one. Also on Android, Google Play, we should be there. So you can find us numerous places around the global web. Let's start off here with the all-important World Cup. We're down to one match. Will be tomorrow. Today in what used to be Leningrad, Belgium, 2-0 over England. So that was the fight for third and fourth place. England will be in fourth place. Belgium will be in second place. Tomorrow, the fight for first and second place. France and Croatia. Croatia being a surprise. We thought we'd bring that to our football fans worldwide. We'll spotlight today the Fed. The chair of the Fed will make his annual Humphrey Hawkins report to Congress starting on Tuesday. That is mandated by an act of Congress. At the time, it was Senator Humphrey of Minnesota and Representative Augustus Hawkins of Los Angeles. It's a very important production where the Fed will answer questions from the members of the Congress and as to where they will be and what the Fed is doing in line with its dual mission of maximum stability and maximum employment. We'll have here the Fed's minutes, some recent Fed's minutes. We'll go over those, and we'll look at the rising price of producer prices that are rising, the effects of tariffs in this broadcast. We'll get our market information this time around, primarily from CNBC. We'll see how that works out for us. So we're moving around everywhere from the BBC to Bloomberg to Reuters and CNBC and points in between. Let us get started here. We'll start with the effects on such things as literally laundry products. We'll talk about those. Very interesting situation there. We'll hear a little bit here. This is from Bloomberg, and let's go.
About the reaction anytime there is sort of an escalation, right, in the storyline, the headlines at least related to trade wars, is that, of course, it becomes somewhat a risk-off and rates rally, and we have the 10-year going lower, where in reality, that is an inflationary pressure. If anything, the 10-year will be higher as a result of that.
This is the ultimate question, I think, of the moment, which is, are trade tensions going to be inflationary or deflationary? And, you know, Joe, what do you make of that? What's your answer to that question?
Well, the textbook explanation would say that trade tariffs are a tax, that they're inflationary. We've seen that with select asset classes, washing machines and the like, up 20% since that tariff was put on. However, the ability to impact business and consumer sentiment is very high. So I think in and of themselves it's inflationary, but the after effect would be a business slowdown.
All right, so Matt, come on in here, because a lot of people are looking at that yield curve, seeing the expectations for growth dropping as the likelihood of a trade war picks up. What's your view? Is it time now to buy treasuries?
Treasuries are not a terrible investment at a 285 in the 10-year. We see real difficulty at a 315 to 325, getting above that level. So it's not an environment to be overly afraid of Treasuries. Probably a push higher, but the trade tensions are inflationary long term. But remember, the feedback loops are a stronger dollar and a more active Fed, which suppresses the market near term. So inflationary long term, but suppression near term makes the 10-year not a terrible investment, and particularly not at more of a 310 level.
One thing that I'm struck by, Oksana.
I'm always here to create some dissonance.
Please, bring it on.
So I'm going to kind of put this in a bit of a different light, right? We've just gone through a multi-year period of an extraordinary accommodation from the Fed, and the mantra through that period was, don't fight the Fed. If you're trying to go short treasuries or if you're trying to stay away from that risk, you're fighting the Fed. Well, the Fed is not your friend anymore as a fixed income investor. So all of the investors that were sort of espousing that mantra of don't fight the Fed when it was friendly should now start to kind of believe it on the other end of this, because that's really the biggest issue, I think, for fixed income markets and treasuries included, which is the reduction of the Fed balance sheet.
Okay, well, taking that, let's look at a chart that I find really fascinating that shows the massive divergence between the long and short positions in the Treasury market. You could see that the divergence between the real money longs and the speculative shorts has reached the widest since back leading up to the last financial crisis. So, Joe, who's right here? The longs or the shorts?
I believe that 285 is not a bad entry point.
285% on the 10-year Treasury?
10-year, correct. And I think that the longs are more correct. We heard the Fed for the first time in recent weeks or days comment that they are hearing in local districts that businesses are slowing CapEx. We really need CapEx at this late point in the cycle to increase productivity and extend the cycle. So the fact that certain Fed governors are talking about it tells me the Fed will be somewhat reactive should this go much further.
But let's look at the supply-demand dynamics of the market. We are on track to issue roughly $2 trillion of fixed income this year in the U.S. across the board, which is $400 billion above the $1.6 trillion average over the last 5 years or so. And most of that extra issuance is coming from treasuries, given the significant deficit that we have. The Fed is on track, at least given their current guidance, perhaps they change it, but given their current guidance, is on track to reduce their demand for the market by $200 billion through the second half of the year, as our largest sovereign buyers are buying less, as banks are holding less because they're less regulated, et cetera, et cetera, et cetera. So the supply-demand dynamics is what is going to continue pushing yields higher, and much less so, how many hikes is the Fed going to do or not do, et cetera.
So you think that the speculative shorts are more accurate here?
I think that, when we look at the longs and shorts, when you think about the fixed income market in general, where is all of the exposure? There's trillions upon trillions upon trillions of dollars that are long fixed income. So I think comparing that to some speculative shorts, it pales by comparison. Having said that, we're certainly not short the 10-year Treasury here. We find it much more effective or efficient to be short minus 40 basis points on the German midpoint, right? That is a completely artificially created price point by the ECB.
All right, so Matt, you're a real money manager, real investor, and you have to actually put money into fixed income instruments. So, given Oksana's point here, which is that it's a supply-demand dynamic and the Fed is rolling off its balance sheet, are you concerned about holding a significant duration exposure here?
We're not. We would prefer an up-rate trade in Germany, and we currently do. I would agree with the shorts in the near term. Again, a near-term push after this unwind down to 285 makes total sense. But longer term, the fixed income markets also are more concerned about downside risk than equity markets. So equity markets can continue to do well through a trade war. However, fixed income markets need to be concerned about that downside. And that's why you've seen treasuries move lower, corporate bond spreads move wider. It's a quite logical move given the asymmetric payoff in fixed income versus equities.
Yeah.
So near term, slightly higher yields, but not a prolonged move higher, no.
Matt, when do we see the next recession?
Next recession today looks like a 2020 odds are moving up above 25%, but you still can't say it's the majority outcome. So we still think it's beyond that, but the odds have at least doubled of a 2020 pullback given the fiscal stimulus roll-off as you get through 19.
What about you, Joe? What do you think?
We think it's likely H1 2020.
All right, so you agree. Oksana?
Late 2019, early 2020.
All right, and you think that that's what the yield curve is trying to signal here?
It's really hard to assume that the yield curve is signaling really much of anything here, given the amount of central bank meddling that fixed income markets have seen, given the extraordinary amount of liability management, long-term liability management that is coming into place, right, with the demographics, with the population getting older. There is probably demand that's going to continue anchoring the very long end of the curve, but 10 years and in is very much susceptible to those supply-demand dynamics, and of course what the Fed is going to do. And nothing I'm hearing from the Fed is particularly dovish. So.
All right, Matt, real quick, when do we see a yield curve inversion?
We think you actually will not see a yield curve inversion. We think you actually will bottom near the end of this year. The ECB will be in play late this year, early 2019, and that will allow the yield curve to invert. So we would put that well into the future and call that like a late 2019, early 2020, if it happens at all.
Joe?
2019 event, hard to say exactly when, given a lot of the technicals that Oksana spoke about, a lot of moving flows, the U.S. inflation, wages, what the ECB chooses to do, and the like. But the recession will follow the inversion possibly by 9 to 15 months. Could be a while.
All right, you heard the...
There was a story that caught my attention this week, a Bloomberg story, looking at how at least 69 companies have increased their debt loads by 50% or more in the past 5 years. And it raised a question, are we getting to the end of this cycle and will there be a reckoning? Joe, what do you think?
I think at the end of a cycle, you always get distortions. It's not just in the high yield market or the loan market. In the investment grade market, the BBB component of that index has roughly doubled. So for investors that are in passive vehicles, they might want to think, is a passive vehicle necessarily safer? We don't think indexes are necessarily safer. Active management can certainly move you away from some of these issuer concentrations.
Matt, where do you see the biggest distortion right now?
The issuance distortion has been in the corporate space, and the debt to GDP just from corporate issuance in the U.S. continues to rise and is beyond a pre-crisis level. And that's very different than in the consumer-oriented space, where debt to GDP in the consumer-oriented space continues to fall, i.e. the consumer has grown into the prior excess debt load. So we would point eventually to the IG credit space, BBBs, and EM, specifically corporates with it in EM, where we would see potential dollar funding issue. Those are the potential seeds of concern in the future.
Oksana, I want to get to leveraged loans because a lot of people have been raising this as a possible hotspot of concern. You've seen a near record pace of issuance so far this year after a record year last year. Covenants are eroding. Do you think that leveraged loans are going to see much lower recoveries in the next downturn than perhaps even high yield bonds?
So it's not surprising that we're seeing this tremendous appetite for loans, of course, because they are one of the few pockets of fixed income this year that have actually delivered positive returns as everything else in fixed income struggles. There has been certainly deterioration in the quality of the issuance, and therefore, for example, in our portfolios, we were very bullish on loans. We are very selective holders, but not very active adders at this point in that space. It will continue to benefit from flows, and technicals really matter in this market that's been dominated by ETFs, et cetera. So loans likely have some room to run here, but certainly fundamentals are becoming a higher concern because as more and more deals come to market, there is almost, this whole idea of loans being senior and their seniority in the capital structure starting to matter a lot less as covenants deteriorate and you have more second lien issuance, and there's often no one behind you, in that capital structure, so this whole seniority argument sort of starts to deteriorate.
Joe, what's your perspective? Leveraged loans, pro or anti?
Pro, certainly. To Oksana's point, there's certainly more risk now than there was historically. Leverage is high. One thing to point out in both the high-yield bond market and the leveraged loan market is, of course, a collection of individual stories. Many of the leveraged loan issuers that get covenant-light status, so to speak, are really high quality. So you have to differentiate between what you can tolerate as a covenant-light and what you can't.
All right, Matt, you did bring up emerging markets, and you seem to suggest that could be an area where we do see stress. So right now, given the sell-off that we saw certainly last month, are you starting to experiment and sort of trickle in, or are you staying away from this area at this point?
We do think it's a time where you can find winners versus losers. It's been a play that was overexposed to global trade, dollar strength, and the like, and so it's been the right place to avoid. But there are countries doing the right things, raising rates to defend their currencies, Mexico's, Indonesia's of the world. And those can play out very differently than the Turkeys of the world, which has an array of trouble from a political and a financial crisis standpoint, and the Argentina. So there are going to be winners and losers. It's time to look in the EM markets for opportunities, but it's not yet time to just blindly buy.
I feel like everyone says this. They say, there could be opportunities, but don't go near Turkey or Argentina. Is that your opinion?
Very different from what we were hearing at the end of last year and early this year, where most of the voices were saying EM is a great opportunity, emerging market debt, especially local currency, and all you hear now is stronger dollar, right, rising rates in the developed world. If you look at the amount of defaults that have been that we've had in sovereign EM over the last 20 years or so, 25% of them occurred in 2017. I mean, there hasn't been that many. There's been like 20, but 5 of them happened last year. So certainly there is some deterioration in fundamentals there. And my final point is it's very hard to imagine EM strength, emerging market dollar strength, in a world where developed world rates are going up and dollar is strengthening and there's various inflationary pressures in the developed world. And finally, technicals haven't yet started to hit that market. And when people start to pull out their money through ETFs, et cetera, that's really what can create a significant sell-off.
All right, we'll leave that commentary as we previously stated. The word recession is bandied about. That makes the economy somewhat tenuous. Now they're talking about 2019, 2020. It does take months for things to work through the economy. However, the current economy, 2018 economy, in industrial capitalist countries tends to work faster than what you would normally think if you look at the yield curve, etc. Because what is happening here, trade, for instance, and now some small items, the laundry machines are up 20%. And as more of these tariffs come into effect, you'll see inflationary pressures, and that we have here. The U.S. wholesale prices rose in the 12 months ending in July, the most since 2011. The cost of services accelerated. That's from the Labor Department. And the key takeaways here: the figures which measure wholesale and other selling prices at businesses indicate inflationary pressures in the production pipelines are affirming, and amidst rising demand and tariffs on steel and other goods. The June index for final demand services climbed 0.4% from a month earlier, the most since January, and 2.8% for the same month a year ago. More than 40% of the advance was due to higher retail margins of fuel. The gains also reflected a 1.3% month-over-month jump in truck transportation of freight, the largest in dates back to 2009. In contrast, the cost of goods rose 1/10 in June from a month earlier, reflecting cooling energy prices after 1% surge in May. While consumer price index, that'll be due out on Thursdays, considered a more important indicator of inflation. The producer prices help provide insight into a direction of input costs that businesses are facing. Concerned about higher material and service costs remain elevated after the U.S. imposed tariffs on aluminium or aluminum earlier this year, followed by additional levies on Chinese imports. There are about $200 billion of that going around out here. Excluding the volatile categories, of course, food, energy, trade services rose 0.3% from the previous month, following a 0.1% increase. Energy prices rose 0.8% from the prior month after jumping 4.6%. Food costs fell 1.1%. So some of the items coming out here, we start to look at some rising costs. Let me just go around here a bit and sort of skip around. The U.S. has lifted a ban on ZTE after $1.4 billion penalty. ZTE is a very large Chinese corporation. The ban was removed after, of course, the fines paid placing a $400 million in escrow at U.S. banks. The sum comes in addition to $892 million in penalties the telecom equipment maker has paid to the U.S. government after pleading guilty for violating sanctions. ZTE is a very large not only equipment maker, but they also make smartphones. So this is one of the things ZTE, will set out with full confidence after the U.S. lifted the ban. That is according to Lucino, a spokesman for ZTE. They have reorganized. Department of Commerce granted ZTE a temporary reprieve here to operate in terms of limited situation. Now, some of that is depending on what Congress does here, and it will go around. We talked about the producer price index. We'll get to the Fed minutes in the minute here, and let's see. Federal Reserve, this is from the Wall Street Journal, report defends use of new tools. Now, we talked some, at least when we covered the news conferences of Chair Yellen. This is from on the 13th of June. Nick Timmerose, writing in the Wall Street Journal, defended having the flexibilities as a Fed to set interest rates by using relatively new tools, but including paying interest to banks. In its annual report on a Friday, some lawmakers, particularly in the House of Representatives, had criticized the Fed in recent years for using its new facilities that enable the central bank to guide short-term interest rates higher while maintaining a much larger portfolio of bonds and other assets than existed before the Depression. The criticism reflect in part broad concerns on the part of these lawmakers with emergency steps the Fed undertook in 2008 through 14 to stimulate the economy, called quantitative easing. The report released on Friday includes a 3-page overview of new tools that can serve as preemptive and rebuttal against future concerns lawmakers might raise next week. The Fed dramatically expanded its bond portfolio. That was in 2008. The vast income in reserve, which rose to more than $2.5 trillion in 2014 from about $15 billion in 2007, makes it hard for the Fed to change interest rates by buying or selling securities in the open market, as it had before 2008. Getting the price of asset sales just right for achieving the Fed's objective has been extremely challenging. Would have run the risk of disrupting the financial markets and hurting economic growth. Reports said last fall the Fed began gradually shrinking its bond portfolio, but not replacing some of the bonds when they matured. The Fed hasn't decided on how long the runoff will last because it doesn't know the optimal level of reserves going forward. The size of the Fed's hold is likely to be much lower than it is today. The report didn't elaborate on whether these discussions around the longer run rates setting a framework has proceeded. Nor did the broader 63-page report provide any clues. We have some of that here. The Fed has raised the benchmark, a short-term rate, to between 1.75 and 2%. Last month, I predicted more rate increases. There will be more, perhaps 2. The Fed is close to meeting its goal than any point in 10 years. The unemployment rate is at 4% in June and has been over the past 3 months. Consumer prices rose 3 to 2.3% from a year ago, excluding food and energy. So this is some of what they use, the Fed, to gauge what is going on here. Let me go to pause just a minute for a non-commercial break. And we'll take a look now at foreign direct investment in the U.S., new foreign direct investment in the U.S. 2017. This is from the Bureau of Economic Analysis. It was released on the 11th of July. Expenditures by foreign direct investors to acquire, establish, and expand U.S. businesses totaled $259.6 billion. That's preliminary in 2017. Expenditures were down 32% from $379.7 billion. That was revised in 2016. And we're below the annual average of $359.9 billion in 2014 and 2016. The 2017 expenditures, from acquisitions were $253.2 billion. Expenditures to establish new U.S. businesses were at $4.1 billion. Expenditures to expand existing foreign-owned businesses at $2.4 billion. Planned expenditures were included both in the first and planned future expenditures until completion of the projects in 2017 were $278 billion. Expenditures by industry, country, and state. New direct investment in manufacturing at $103.7 million accounted for 40% of the total expenditure. The target is shared amongst major industries within manufacturing. The largest in food manufacturing at $34 billion. There are also large expenditures in information, $25.7 billion, and in real estate rental and leasing at $17 billion. By country of beneficial owners, a small number of countries accounted for the most investment. The largest investment country was Canada, with investment of $66.2 billion, followed by the UK of $40.9 billion, Japan at $34 billion, France at $23.1 billion, and by region, Europe contributed 40% of the new investments in 2017. States, the largest expenditures were in California, $41.6 billion, Texas, $39.7 billion, and Illinois, $20 billion. Greenfield investment expenditures, to establish new businesses and expand existing foreign-owned U.S. businesses were at $6.4 billion in 2017. Planned expenditures until completed were greenfield investments initiated in 2017, which included both first year and future, were at $24.8 billion. U.S. industries by expenditure, the highest were in manufacturing, $1.6 billion, accounted for 24% of the greenfield expenditures. By state, greenfield expenditures in 2017, the largest were in Delaware at $1.2 billion, and in New York at $16 billion. Employment by newly acquired, established or expanded foreign-owned businesses. There were 554,300 workers. Current employment acquired enterprises was at 549,000 1,700. Their total planned employment, which includes current employment, acquired enterprises, planned employment, etc., 577,200. By industry, 255,100 as manufacturing, administrative support of waste management services at 55,500. By a country, UBO, France accounted for the largest number of workers at 47,000, followed by the UK at 42,100 and Canada at 39,000. By states, Virginia was the largest employment category, but employment value is suppressed due to confidentiality. The largest state employment were Missouri at 63,000, California at 55,700, Florida at 55,500. Employment from acquisitions operate in multiple states. U.S. businesses acquired 365,700, established 5,565. That is was a previous, now the revised estimate at 379,728. U.S. businesses established 6,400. Excuse me. Tried once more. 6,504. Expanded at 2,907. Total expenditure on the revised at 394,964. This is released in July. And let me see if we have any more things here. We did the direct investments. Greenfield investments includes establishments and expansions, is what they call it. So in other words, this will do it for that report, and now we'll hover back to, let's see, where will we go from here? We'll figure it out here. We did the Wall Street part. Let me see. We'll do the markets a little later here. We'll look a little bit at the Fed's minute, the stat review of economic situation. This is on June 2nd through 13. That's when they are reporting. This report, incidentally, wait a minute here. This is an older meeting here. I'm actually going to skip this because this is really not what we wanted. This is for June, and this we want July. So we kind of it does happen sometime. You pull the wrong report up, and here evidently we did pull the wrong report up. We'll just have to get that later. This is from the Board of Governors here, and let me just look over here. Oops. Well, we'll just have to go. We don't have the 66-page report. In our next report, we will have that, so we'll just settle for that. So we know when to, as they say, move on. Let me just sort of backtrack a little bit here to make sure we got everything. Yeah, producer prices, we got it taken care of. We'll look at an emerging market here. Ghana growth targets at risk as banks pull brakes on lending. This is on the July the 11th from Bloomberg. A reluctance by banks in Ghana to lend is threatening to stall one of Africa's fastest expanding economies. Almost a quarter of all outstanding loans in the country at risk of not being repaid. At stake is 6.8% growth, but the government is hoping to achieve domestic product, the second in the West Africa's second largest economy. experienced its quickest expansion in 5 years in 2017. Oil and gas production surge, followed by a peaceful transition there. While inflation has almost halved to 10%, which in emerging countries, excuse me, it's not unusual to have 6 to 8% inflation. So this is tolerable. Room to cut the benchmark rate to a 4-year low. This is the central bank. Banks said they're playing it safe because of loan default trends. That is from Harrison, economist at Accra-based Frontline Economic Advisors. Non-performing loans increased almost 21% to a record $8.63 billion, and that's $1.8 billion in April compared to a year ago. The Bank of Ghana has since last year tripled the minimum capital requirements for lenders. A very good idea there. The oil boom, and this is something I was not aware of. The central bank says in May the growth in its composite rate of economic activity has slowed to 2.3% in the 3 months through March, from 4.5% at the same time a year ago. And Ghana's growth, boom and bust, have been closely linked to crude oil prices since it began as a producer in 2010, even though oil directly accounts for less than 10% of GDP services, which include trade, real estate, finance, etc. The private sector is the engine of economic growth and cannot thrive without sustained means of financing. That's from an economist, George Martley. Anyway, that is from Ghana. And let me just look here. We'll go ahead and do the markets while we're here. And let me just probably going to have to do this a little bit differently here. And let me just get back to Bloomberg here. We're going to have to get some of our information from various sources, not unusual in this game. And we'll kind of have to move around here a bit, which we can easily do. Let me first go to Asia. We usually start out there. The Nikkei at 409.39. Hang Seng at 44.361. 61. Okay. And what else do we have? Well, that's basically the Asian markets from Bloomberg, and across Europe here, the FTSE at 10.54. The DAC in Germany at 47.76. The CAC, that is in France, at 23.30. And in Spain, they are down 32.60. And the Dow Jones was at 94.52. And let's see, the NASDAQ at 2.06. So that is that part of the market. And let's go back here and we'll look at the commodities. This is all from Bloomberg. And then we'll skip on back to CNBC. Anyway, nonetheless, the Bloomberg Commodity Index, as we used to call it, at negative 0.36. And the Reuters Jeffers also was down at 0.27 was the change in that index. And the Reuters International at 1.78. I guess we'll get energy while we're here. We'll start with Brent crude at $75.33. The change was 88 cents there. And we go to West Texas Intermediate. That is the domain of one T-Boone picking, at least it was, at .88, also at $71.01. 0.68, 68 cents, how you want to have it. Let's see what else we got. The gasoline index was up $3.50. We can get the precious metal here on the comics. Gold was down $5.40 at $1,241.20. On the spot, it was down $3.07 at $1,244.32. Silver was down 16 cents. It's resting at $15.82. It won't mess with platinum here. Look at corn. It was down $4.50. Cocoa was up $28. And live cattle was down 22 cents. So that is our commodities. And now let me go back to CNBC and look at, we've already got gold here. The 10-year treasury, you heard something about it, was down 0.24 at 2.829. And the euro was roughly $1.16. The VEC was down 12.18. And we got the NASDAQ. S&P 500 was up 3.02. The CNBC IQ 100. Anyway, we got gold, we got the euro. We did the NASDAQ. The NASDAQ 100 at 9.57. The S&P 40, we've not done that before, was down 0.38. And the Russell 2000 was also down a negative 3.20. And we gave the Dow before 88.04. And some little different things going on here in their commodities. We'll bring these in. We did silver. Wheat was up $12.50. Soybeans was down $14.75. Corn was also down $5.50. And we talked about Treasury, the 3-month Treasury. The yield was 1.976. The 2-year was down 2.582. The 5-year was also down 2.727. And we gave the 10-year. It was down 2.829. And the 30-year was also down 2.933 for those that are in that particular situation. So these are the CNBC numbers here. We get them from a number of different standpoints. Let me just very quickly here go to the BBC and their business report. We wouldn't want to leave them out of anything here while they're recovering from their defeat. And the big thing, Papa John has been forced out of many major league ballparks because of a racial slur that he spoke. One of the big things here. China trade surplus with U.S. hits a record high. A big headline, and we'll take a look at it. Also, the Trump administration filed an appeal against the AT&T Time Warner deal. We don't want to forget that one, but we'll look at this one. It's on the 13th of July. China's trade surplus hit a record high of nearly 29 billion. That is 22 billion pounds. In June, as exports to America remain strong, the figure comes a week after the trade wars begin. The U.S. imposing tariffs on 34 billion of Chinese goods and the retaliation. The 10% on another 200 billion. We expect the trade numbers for July to disappoint when the first round comes in. It takes a few weeks to come in. For the first 6 weeks of the year, and China exports to the U.S. rose 13.6% from a year ago, while imports from the U.S. increased by 11.8%. The trade surplus on the same period was 133.76 billion. That is up from 117.5 billion last year. The kick-on effect, the largest exporter, China, has threatened retaliation against tariffs and pledged it would lodge a complaint with the WTO. So that is sort of an ongoing trade war. We heard in a little can production there some of the results of it. China has another option. Beijing could reduce the impact of U.S. tariffs by on exports by devaluating its yuan, making its goods cheaper for American consumers. One of the many ways that they could do this. Let me just go back and take one more look at the BBC and make sure we didn't miss anything. I don't think we did. I think we got everything we needed to get. Let me just take a look at their market data here. I think we did the FTSE was up 0.14%. That was the FTSE. We did the Calc 40. They do it a little differently, 0.43. Not trying to confuse anyone. The DAX was up 0.38. In Bombay, they were down 0.02%. The Hang Seng, we hadn't gotten the Hang Seng yet, at 0.16, and the Nikkei at 1.85. And let's see what else we have flying through here. And we did that already. And natural gas. So we got everything under there. Commodities report here. In Amsterdam, they were at 0.56% there. We make sure we got everybody in here. We got Spain, and in Bombay, we got Bombay down 0.02. The Hang Seng, we got that, and we got the Nikkei at 1.85. We're dealing with various sources here. You want to get those going. And also, we'll go very quickly to Gas Buddies here. We do them to check on current gasoline prices. Yeah. Anyway. Yeah, we'll see where we are. We'll just do it for Boston, and then we'll do it somewhere in California. I'm not certain where in California, but somewhere in California. In other words, we'll be doing the east and west coast. We hope. Shell, let's see, $3.19. That's in Boston. Basically, yeah, that's okay. $3.19. So we'll go to well, somehow we came out here. I don't know how we came out with Oklahoma City, but it's $2.86 there in the oil belt. And let's see if we can finally get LA here. The lowest prices in California at the Costco, I guess this is in Northern California, at $3.14 there, and I'm not sure where we are here. Yeah. Let's go to LA. That is the city of cars. We have to get it. Yeah, the prices are down. A Sinclair there at $3.35, comparable to the East Coast, and Arco at $3 also and 35 cents. That is in Los Angeles. We can go up to Northern California and let's see, San Francisco, and that'll be the last one we'll do here. It's going to cost more there, and Arco there at $3.49, a mobile at $5.53. So it gives you a sense of where gas pricing is now for the all-important summer driving season. Next week we'll be looking at the annual Humphrey Hawkins report to Congress by the chair of the Federal Reserve. We'll get to see what is new and what is not. Very difficult probably to say what is new and what is not, but at least Chairman Powell. We'll see what is going on there. We just want to make sure we didn't miss anything. I don't think we did. Here in economic news, German workers, here a big headline here. The arrival of more than 1 million refugees in Germany in recent years, nearly torn apart. The government is also the reason why the country's workers could soon be taking home more pay. Very interesting there. Even if the influx of mostly young workers is likely to be a drag on the gross wage growth as a competition labor market increases. Net pay might still rise. That's according to Oxford Economics, and that's Daniel Hardenberg. His research shows the contribution there to Germany's social insurance system. Younger people pay in, older people receive an additional increase in net pay compared to a scenario without refugees. Reached 0.5 would reach it by 2025, accelerating to 2.5% by 2055. These people will be old. Wages will rise around 3% a year through 2050. And so Germany is bringing in is an important component in solving the problem of an underfunded pension system. That could also happen here in the U.S. And one of those things that you see, one thing to remember, that immigrants do pay withholding taxes. It doesn't even matter if they are using a name that's not their own, as long as they have a Social Security number. It is charged to that account, therefore they are paying the piper, so to speak. This was from Bloomberg Economics. This will do it for us on the 14th of July 2018 from WBRN Radio and the Bostonred Network. This is the Numbers Man part this week in economics. And have a good week, everyone. For those in business, make it a productive week. For the consumer, the eyes are on the prize. As the temperatures have moderated a little, but basically across the U.S. in the high 80s, and we're in the 90s. In California, last weekend they were actually in the hundreds.